You've been looking into some of the most owned stocks at the moment, and large caps. What was your kind of takeaways and conclusions?
Well, it's interesting. Mike was talking earlier about how the market's kind of drifted sideways the last few months. We've actually seen some stabilization in the performance of the most popular names in large cap long only funds. And that contrasts with late last year when there was some pretty severe underperformance. And these names are generally not doing so hot this year, but there has been a little bit of stability that's emerged just very, very recently. And what that's translated into, frankly, is it's actually ended up helping active manager performance. We're finding that even though their favorite stocks aren't doing so hot this year, that stability has been enough to actually allow a lot of active managers in the large cap space to outperform this year. There have been some other things that have helped, but I think that the kind of end of that bloodletting that we saw late last year has definitely been one of the positives.
What are your sector preferences now in terms of big cap for the rest of this year? It does seem like a bit of everything has already done well so far.
It's a great question. And, I think our sector picks are somewhat boring at this point in time. We really haven't changed them since back in January. We're overweight financials, materials, and energy. And we still see very strong valuation appeal in all three, despite the fact that we have seen some good moves in energy and financials in particular. But look, these are areas that tend to outperform when inflation expectations are rising. And we think that pressure point is still very much here in focus. And then the last thing I'd add is these are three pillars of the value trade. And we think that growth to value rotation has legs through the end of 2022. So we think you might see some bumps if we get a pullback in the market in that reflation trade, but we'd stick with it because we do see a lot of runway longer term.
Does it need higher treasury yields, though, to work? The financials especially, and some of the other cyclical parts of the market. Everyone thought yields were on a one-way ticket higher, and then boom, they're back down to low 150s.
It's a great question, Sarah. And I think you do need that for financials ultimately. We actually find that energy and materials don't trade as much in sync with 10-year treasury yields as the financials do. It's really financials and industrials that tend to have that positive correlation in terms of their relative performance with the direction of the 10-year. But I do think that, when we look at the financials call, we just see a lot of runway from the strong economic backdrop that's in place. And I'll give you one key stat. When GDP in real terms is tracking above the long-term average, which is 2.5%, in any given quarter going back to the 1970s, value tends to outperform growth. And the real big pillar of that value trade is financials. So value doesn't work without financials. And ultimately, we think that economic runway is there. If you look at consensus expectations for next year, they're tracking at 4%, and they've been very, very stable recently. So we think there's a lot of cushion there.
So you expect another hot inflation read on Thursday, sounds like.
Yeah, fortunately, I don't have the job of actually forecasting the CPI. I leave that to my colleague, Tom Porcelli. But we do think the inflationary pressures are here. I'm ultimately, in the camp that I don't think that this is going to really undermine the U.S. economy. I do think it's manageable from a profit margin perspective. But we do know that those pressures are in place.
Lori Calvasina, thank you for joining us with some of your picks.
Shepard Smith here. Thanks for watching CNBC on YouTube.